we'll be talking about the ecosystem in the Emirates of Abu Dhabi and the UAE in general. And we have, and as well, the financing part. So we have with us the two gentlemen and lady, Mr. Ahmad bin Ghannam from the Department of Economic Development. He has thankfully joined us on very short note. Mr. Ahmad al-Bloushi was supposed to be with us, but for some urgent matter, he couldn't make it. And then we have Mr. Amer Siddiqi, who is CFO Mubadala, CFO Strata. And we have Iram Khan from HSBC. What we are planning to do here today is to give some perspectives from different angles, from the government angle and from the industrial owner point of view, and as well from the banker's point of view. To start with, I would like to, start with Mr. Ahmad bin Ghannam, and to give us some idea about the environment in the United Arab Emirates in general and Abu Dhabi in particular, and how it works for the economic, for the industrial projects here.
Yeah, thank you. As part of the government, in 2008, Abu Dhabi government published the Economic Vision 2030. Looking forward at the time, just to understand the conditions when it was launched and published. We were like over $100 a barrel time when we were having a lot of let's say returns coming in from oil at that time. We were looking really forward, saying, okay, how can we reduce our dependency on oil by diversifying the economy, and the goal was to reach to 40-60, where 40 would be the contribution of oil to Abu Dhabi economy in 2030. At that time it was like around 60%, so huge reduction. UAE right now, UAE alone is around 37% oil contribution to the total GDP. So overall, the UAE is reaching there. Abu Dhabi this year around 50-50 when it comes to the contribution of oil to non-oil, and this laid the ground for overall development and the direction, and putting up the right kind of ecosystem where the anchor projects are the main thing was for the involvement of the government, putting up like AGA, Strata, Mubadala itself as a vehicle for putting up anchor projects upstreams, and then developing the ecosystem around it. And this is where our involvement as governments started from that sense. From a DED perspective, the first thing that comes into mind, licensing. We have the Industrial Bureau, and it gets involved with the licensing of the business. And our intent is, as much as possible, is to reduce the obstacles around the project owner, the investor, that is taking up a lot of risk into this project, long-term risk. And this is where we kind of wanted to look into that, reduce the amount of regulation that's required, getting an initial license and go into the project as smooth as possible. of course, there is the industrial strategy that's coming up, and we're going to announce it soon. Not in this conference, but later on. And this is what I have in reference to the overall government involvement.
Thank you, Ahmed, for this, swift introduction about the ecosystem and the Abu Dhabi strategy for the industrial projects in general. What comes to mind actually is when we talk about industrial projects, we talk about two perhaps different players. We talk about startups and we talk about investments coming from abroad, foreign investments. How is what is the role of the government in supporting the startups in Abu Dhabi, generally speaking?
One is we want to get out of the reduce obstacle, reduce risk especially on SMEs, and get them the right kind of information when it comes to getting into the project itself. So we understand that there is an incubation period for these projects. It's a 10-year endeavor, and our role is to put up help them out with regulation. When it comes to regulation, handhold them, and take them to the different various entities, because we're basically the one-stop shop for the investor when it comes to industrial projects. So you need to come into the Department of Economic Development, IDB, and start your application from there. And we have agreements with all entities within Abu Dhabi who are concerned with the regulatory side, from whether it's environmental, energy, whatever else that comes into mind, and do it from our side. So you only need to submit your application first, and then we'll take you through it.
And there are clear processes, as I understand, internally into where the application starts and how it could move, and there is a timeline for each process that you have internally. So as the investor does not take so long in the let's call it the normal routine that you may find in other places.
And we try as much as possible to move the goalpost, meaning we're not today it takes around a day. We want to reach to 15 minutes for the initial license. Now but again, the burden comes onto the investor to go through the whole cycle, because they will get the initial license and then they will have to go and build the factory itself, and this takes time. And whatever NOCs they require, this is where we need to where also the IDB will get into this process and help them out.
I want to turn now to Mr. Amer Siddiqi. Mr. Amer, as a CFO of a company that has started a few years back, I think in 2008, if I'm not mistaken. 2010. What's your perspective? How do you see the starting a company, generally speaking, in terms of the regulations, in terms of starting something from scratch, kind of an inside angle or inside point of view?
Sure. Look, from my perspective, I think be it a startup or a company that already is existing and looking to expand, I think the thing one looks at is the ease of doing business. How easy is it to register? How easy is it to obtain your approvals, to get your licenses, to have access to capital? And these are the typical things that would be on the checklist for any new investor that's looking to come in to invest in the UAE. United Arab Emirates generally already has a reputation of being a investor-friendly place to work. Some of the free zones that are here already established for many years. I mean, just to give an example, Jafsa is one of the earlier ones. Others are coming up. Now, a couple of things that Ahmed just talked about is that before it used to take 1 day, now you're looking to do it in 50 minutes, I believe. 15 minutes. These are the kind of steps in the right direction. This is a common conversation, quite frankly, we have with our partners, because Strata today is based in a 25 square kilometre park known as the Nibras Aerospace Park, and we were one of the first tenants in that park. But the vision we have is to create an ecosystem. What we mean by that is to have not just the manufacturers like ourselves, but also suppliers should be there, logistic providers should be there. And this is one of the questions our partners or potentially other investors ask us, is that how easy is it to actually establish a shop and do business in the UAE? And the response to that is something similar, like I've just said now, that it's becoming relatively much simpler and quicker to get your licenses, to get yourself incorporated, registered, get your approvals. And as we progress along with the incentives or the initiatives that Ahmad talked about, I think it would be even more easier to attract foreign investors to come to the region.
Just I want to add to this. Like last year in September, we did the linkage program, linkage industrial program, where the anchor industries like EGA, I think Strata was there, definitely Tawazun companies were there, and the whole point was the SME ecosystem around these organizations, factories. They would come in and say, you know what, you are importing so and so product from abroad. We can, it's been developed here locally, and we're starting this kind of dialogue between factories that are in place, and this is something that we do every year, and looking forward for having it happening next September, hopefully, where even investors coming in here, they will not come in to a barren desert. There is an ecosystem, and you can capitalize on these anchor industries from that sense.
Ahmed, you touched on a very important point about investors coming from outside. This takes me to a different area, perhaps, in terms of the incentives that could be given, or at least the incentives that the foreign investments can see in the UAE. What is it for them? How can we attract more of investments coming to the UAE, whether it was at an anchor level or it was at a smaller level that will work around these anchors as an ecosystem?
I can speak from a DED perspective, and Abu Dhabi government. We're setting up an Abu Dhabi investment office that will look into helping out investors from abroad get information about investment opportunities, and then help them out with the whole process from a one-stop shop kind of perspective. Again, the issue is reducing risk. If someone is coming in from abroad, they need to have full information. They need to have the service that they need, and they need to come into an ecosystem that's welcoming, and they can grow through that. And again, the UAE by itself is a platform to other regions. Again, we talked about this beforehand, the tax-free environment, even and the repatriation of capital, and we're a business-friendly environment, and the other thing is the human factor. You have we say we're a country of 200 nationalities coming in from all over the place. We're just, as UAE nationals, we're only 10%, and we're not threatened by this. So we're happy with the situation, and I think it's a land. new land of opportunity, if I want to say, if I may say. So
Yes.
Ali, one thing I'd just like to add, I think we must not underestimate of the fact that the United Arab Emirates today is a tax-free environment. Everywhere else in the world, corporation tax is quite high. So I think living over here, we tend to take this for granted, but at the end of the day, it's a significant incentive for any foreign investor to set up shop over here and not be subject to local corporation tax.
Fantastic. Thank you for this. The other thing that comes to mind as well when we talk about industrial projects, we talk about the regulations, the laws, the ease of doing business. All this is important, but there is another point that maybe it's the other angle that we are going to get in. Is the financing and funding of such industrial projects. As a CFO of a company that has started 7 years back, how do you look into the issue of financing of industrial projects? How easy it is, or how hard it is? If it's hard.
Look, it varies from industry to industry, and I'll talk about the industry I work in. Manufacturing is a tough industry to work in. Margins are fairly restricted. It's a highly capital-intensive industry, and frankly, by the time a business starts becoming cash positive, you're really looking at 7 to 10 years post-inception of when it starts seeing positive returns. My observation is, and having spoken to a few peers of mine who are CFOs of other companies, is that the banks in the local region tend to be less enthusiastic when it comes to taking on board the risk of debt when it comes to a manufacturing or industrial startup company. And that's simply for the reason I gave, that it takes 7 odd years for a business to be profitable or cash positive. And the reasons behind that is, by the time you've brought on all of your projects, you've ran production, you've got to the bottom of the learning curve, that's really when you start seeing synergies and economies of scale. So whilst per se I wasn't exposed to those problems, and the reason for that is that I openly say this, Strata is very unique in the situation that it's very high profile and it has a very strong shareholder backing. I really wonder that if I was the CFO of a company which didn't have the big shareholder behind it, how easy would it be to go out and actually raise debt, given I feel that the banks have a less appetite when it comes to exposing themselves to this industry. Commonly, I use the example that manufacturing is a bit like running a marathon, not a 100-meter dash, or playing Test cricket as opposed to one-day international. You need to have patience, and you're looking at a 7 to 10-year partnership. That's where I really throw the question back to the banks to say, what is their view about this?
That's exactly where we are turning to Iram. As a banker and financer. And generally speaking, not only from HSBC point of view, but from any financer point of view, how do you look into this? It's the bank's angle now that we need to know. We just heard the CFO saying that it's not easy, it's hard, and it's challenging. And banks are not somehow looking into these startups the way that it should. What's the bank point of view in this kind of financing of industrial projects?
Yeah, so I think probably it would be useful to just give a little bit of a market update. I think UAE as and the broader GCC for that matter as a region has progressed by leaps and bounds in the last decade. There was a period of crisis, but if you look at the simple numbers, the volumes of lending across loans and bonds, they've just progressively increased post-crisis from 2011. If you look at the industrial sector, actually, I was looking at some data, and last year the industrial sector, private sector lending was probably the largest part of the pie from a sector perspective, numbers being around $33 billion, and another 12 to $13 billion coming of lending to the public sector. So from a regional perspective, you know, the lending, the broad sort of lending market has been robust and is progressively improving. Local banks are liquid. International banks, particularly from Asia and Europe, have made a re-emergence, which has helped in keeping pricing quite stabilized for borrowers in the region. And also, whilst the tenor sweet spot is around 5 years, you are seeing banks lend longer term tenors, 7 to 10 on a commercial basis, and on project basis much longer than that. So I think that gives a broader context of what the financing market looks like in the UAE. Now, coming back more specifically to your question, if I had to break it down into what are the banks focusing on when lending to industrial projects, the three main things banks focus on is return on the lending, which is pricing and ancillary income coming from that particular borrower, credit risk, and I think the final thing is that if all fails, then what does the enforcement look like, the recovery from that borrowing. Taking each of those in turn, the very first thing that banks now do is go to balance sheet committees even before they go to credit committees. And in the balance sheet committee, the simple analysis that is done is that, okay, this is my risk-weighted asset. What is the return on this? You look at the pricing, you look at the overall relationship, and you come up with sort of a threshold as to what the return on that asset is. And every bank has a different internal threshold for that credit. After that, you look at the more sort of detailed aspect of the credit itself. What are the risks associated with this lending? You know, you look at from a risk perspective, as Amer talked about, cash flows is a very important aspect of what banks look like. But there are aspects of improving the structure. You know, for instance, many project level financings have been done by capitalizing the interest cost in the first 4 years, having no repayment in the first 4 years, and basically taking the debt service actually kicking in after the project becomes commercial. There are other ways of sort of putting structures in place as well as having, you know, a shortfall guarantee or a completion guarantee as opposed to guaranteeing in the entire project. So I do agree with the analysis that yes, banks do find it more challenging to lending to because of increased credit risk in terms of lending to smaller projects. But it has been done, and I think you know, ultimately it is working with the borrower to come up with a structure that works for both parties. I mean, we can talk a little bit later about what sort of some of the main pillars are in terms of project financing. Improving on those pillars, other than just focusing on cash flows, does improve feasibility.
I will ask now 3 questions in one. Actually, because of time, we have, you know, and we have the next session for Dr. Marzouki as well.
That
and we want as well from the audience to share with us their points of view. So the question will be this way. Actually, these are 3 different questions, but I will try to ask the 3 questions in one question. The very first one is about the other modes of funding or the alternatives, let's call them, and this is for Amer to look at. And the second one is related to what's the government role here? How the government can support? Is there something that is called subsidizing, for example? And the last question, or the third question, will be back to Iram here, from the bank's perspective, perhaps how to, you know, how the projects can improve their financing feasibility. I think those are kind of interrelated. That's why I'm trying to put them all together into one question that I will start with Amer in the beginning.
Certainly, we've already touched on conventional finance, or vanilla finance as we call it. Other potential options out there, Islamic finance, commonly talked about these days. Unfortunately, I can't claim to be any specialist on Islamic finance. I have very limited knowledge. What I would actually say, though, is I think there is a responsibility out there with somebody I'm not sure who that somebody is. Is it the bankers themselves, or is it the intermediaries like legal firms who advise on these transactions? But there's a responsibility to make CEOs and CFOs more aware of non-conventional financing options, particularly Islamic finance. There seems to be a lack of knowledge and understanding of it, and we typically tend to just go down the conventional route. Perhaps it's a product that is better for a loss-making business for the first number of years, and then it turns into a profitable business. I don't know, but generally I feel as there needs to be a bit more awareness. You touched on the topic of government grant. Look, over the last 15 to 17 years, just as a statistic, $98 billion of government grant has been provided across the globe. It varies from nation to nation. For developed nations, it's more in the form of research and development. For developing nations, it's more in the form of critical infrastructure, capex, plant equipment, machinery, and building. And this is actually a very important mode of financing that particularly is provided to startup projects which are strategic to that country's development. Now, it's normally managed through a regulatory body. The regulatory body is assigned by the government, and that body decides on what is critical, what is non-critical. And it plays a major role when it comes to competitiveness, because if there's company A who has in company A in country B who is competing against company C in country D, one of them's received subsidy, the other hasn't, then unfortunately the one that has not received the government grant has to recover the investment made on infrastructure in its pricing, whereas company A has the benefit of not having to recover that investment. As I said, it's a significant number, $98 billion, and it's an option that should be looked at and made available for strategic projects.
Where does the government come, Ahmed, in terms of support? And here we are talking generally speaking about whether it was direct subsidy or it was other forms of support that may not be subsidizing, but maybe relaxing certain things, perhaps that will reflect on the project.
Yeah, well, just in coordination with the Chamber of Commerce last year, we did the Abu Dhabi Business Forum. It was in May last year, and it was like a kind of a ground-up approach where we listen to the private sector and in various issues. What are the challenges that are being faced by the private sector? And this is and we put up a program to address the different issues that the private sector is facing. We're talking about from regulatory point of view, things that are dealing with industrial, and one was about financing. And although, you know, we had a really nice, you know, positive perspective from the banker's view, let's, you know, from the other side, the private sector is facing a challenge in getting a finance, especially from the manufacturer and industrial side. And they see the bank numbers and they say, okay, the banks are doing really well. Why don't they just take a bit more risk to increase their base? Once you know, the government wants us to go into industrialization, because you know, and increasing the let's say the income coming in from the industrial side, but we are still facing some challenges. So what we did is we had like 2 weeks ago a discussion with the central banks, represented also by some banks, where we're going to have a workshop, and hopefully in early on mid of April, there's going to be a workshop with the banks, central bank, and the private sector coming in, where some solutions will be proposed to the private sector. We're going to gauge in whether this would be satisfactory to our partners in the private sector, and by May, hopefully 16th of May, be there if you have time. The second Abu Dhabi Business Forum will be conducted, where we'll see the impact of these solutions coming in to a wider audience. So we're facilitating this at the end. There are the lenders and the borrowers and the government in between, trying to facilitate this this issue.
This takes me to Iram about the we have heard Amer, we have heard the Ahmad from government point of view trying to find solutions. How banks how can projects actually improve, as I said earlier, the financing feasibility? There should be something that the banks would require, so as it's feasible for them to start financing projects, mainly startups. We don't have issues with the companies that have been in the business for 10 years and more, because they are in the positive balance sheet. But when it comes to startups, how can they do this from your point of view?
Yeah, so I think there are 2 points here. The first point is that typically is a point about education, as Amer said, that bank lending is not the only form of financing capex for industrial projects, or for that matter any project. You have the bond market, you have both the conventional and the Islamic format. The Islamic format, I think the one thing to probably talk about is that the Islamic format is no different from the conventional format from a credit risk or from a commercial aspect of the deal point of view. What Islamic format does allow you is a new pocket of liquidity, and it allows you in certain instances to achieve better pricing because you are tapping into a new base of investors. Over and above the loan market, you also have the bond market. Project bonds have been quite successfully executed in Saudi Arabia, and is something now that the UAE market is looking into for certain projects. And those can also be done in Islamic and conventional format. Over and above that, another pool of liquidity that has become available, and quite a few corporates have actually concluded deals successfully, is the ECA market, the Export Credit Agency market, where ECAs from across the world, to promote their exports to the extent the contract stacks up and the export that they are providing, the equipment stacks up, are able to guarantee lending from banks, which allows borrowers to borrow at on longer tenors at much cheaper pricing. So I think as corporates, it is a very healthy discussion to have with banks around what are the various options to finance these projects. I think the second point around feasibility is that, yes, cash flows are important, and cash flows is something that banks look at when particularly they take deals to credit. But from a project point of view, actually, ironically, sometimes support or parent is not as important, because the lending is non-recourse to the parent. So what you are really doing is you're looking at other pillars. So you're looking at site, you're looking at feedstock, you're looking at the off-taker, you are looking at the contractor, and it has to be sort of, if that package stacks up in terms of, okay, yes, we are comfortable with the contractor, we are comfortable with the off-taker, we know where the feedstock is coming from, we know what the ancillary infrastructure looks like. I think banks do get comfortable lending, considering a longer construction period. And if worst case scenario, as I said, if there is a possibility to provide a shortfall undertaking or a completion guarantee, all that together improves the feasibility of lending to a project.
In the interest of time, actually, we are mindful that we have another session that is going, or should have started 5 minutes ago. So we'll with permission from Dr. Merzougi, I think we can take some questions if anyone wants to ask any question within 5 minutes. We'll have only 2 questions if anyone wants to have questions, and then we'll wrap up the session.
Ali, may I just add one point to what Iram just said? I feel as if I'm a bit talking as if I'm an advocate for SMEs over here. But I think there's a bit of homework that, again, the banks need to do when it comes to collateral to lending. And I'm not talking about the Stratas of this world, I'm talking about the SMEs. When it comes to collateral, most of the manufacturing industry have clients where they are sole suppliers. And it becomes very difficult to provide collateral in the form of assigning your critical equipment or your capex to the bank, because effectively the customer has concerns that if something goes wrong, then the bank can come in and acquire their assets. So there's a bit of homework again from the banking industry to try and find a solution for SMEs in terms of collateral to make it more flexible for them. And I don't think that exists today.
On the capex as well, when we talk about investments that are with heavy machineries, perhaps the initial capital may be financed as well. So we are talking about an initial capital that is coming in the form of loan or finance that is coming from the bank on financial, that will usually come with the lien or mortgage that will consider the collateral. That's very important point in my opinion. If there is no other perhaps question, I will would like, if there is any question, I will take one more question, but if there is no question, I will please.
As Amer alluded to, manufacturing is by its nature capital intensive, and you end up with a lot of valuable equipment that in and of itself you may not want to put as collateral against bank debt. Just welcome the panel's thoughts on maybe taking those assets out of the company, putting them into maybe a separate entity and raising capital or raising additional funds against that particular entity, so that you've got a very lean balance sheet from the organisation that's doing the actual manufacturing, and they can focus on that as their core focus, and use the assets somewhere else. Is that something that's viable? I'm just looking at what are the ways to be slightly more creative rather than equity, often government equity, and then vanilla financing, which is kind of the position that we see ourselves in today.
I might answer you in reference to, the government right now is going into the musataha kind of arrangement where, above the land and whatever on the land, so you can take this, separate this collateral from the land itself and utilize that, and this will open, let's say, an opportunity for financing that wasn't available before, and I think it would even help out the banks when it comes to, because of the legality of transferring or acquisition of land by itself was an issue. So there is a change in policy in reference to that. So this would help. Yeah,
and I think we are now seeing musatahas in some transactions. To answer your question, there are other ways of taking...
Just to give an idea what musataha is. Musataha is a ground lease where you will be given the lease of the land, but you can construct over this land for a long period under the way,
you are seeing structures where a different form of collateral is offered. So one example is pledge on bank accounts. Another example is, for instance, the concession itself. I think the hard part is to generalize this discussion, because every transaction, every project is different. Banks are open to, and you would be surprised that a lot of lending here, although corporate, gets done on an unsecured basis. So banks are open to looking at structures where ultimately, the risk of non-repayment is covered in some form or manner. It doesn't always have to be asset security or land security or, something tangible. And it kind of boils down to sort of taking it as a package for the bank and being able to present it in a convincing manner internally to their credit departments to say, well, we don't have land security or asset security, but we have X, and this is how, when to the extent there is enforcement, we can get our money back.
If I may add one point here as well, I think your point is very important. How to look into what what are the other ways of doing it? How can we structure it in a different way? I think the idea of Islamic banking could be something that is of importance to look at here. There are some transactions that are based on lease and lease back. So this will, on one hand, will help you show that this equipment is leased with certain returns that are coming. And leasing back means you are using it back. And the difference will be where the financer's profit margin that comes, the difference between the two leases. This is not unusual. This is something that is happening, whether it was in the equipment leasing or it was on certain other infrastructure leasing as well, like property leasing. So there are other solutions, in my opinion, but it all depends, in my opinion, that whether this is a startup that has just started or it's a company that's been in business for 10 years and more, and it has streams of cash flow that is coming that covers all the ideas. Sukuk is another way of looking at it, perhaps. Raising Sukuk is the equivalent of bonds, but it has an underlying asset that is behind it that supports it. So these are solutions that may be available in the market, but as Amer said earlier, there might not be enough education into what perhaps other modes of financing available to the to the industrial projects. I think we have, in the interest of time, we have to end the session here. Thank you for everyone for being here, and thank you for the panelists for the valuable information that you have provided.
Thank you.
Thank you very much.